Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
You know, crowdfunding your education may have been pioneered in 1987, and that's a couple of years before there was even a World Wide Web at all. Hello, and welcome to Accredited Investor Markets Radio. I am your host, Christopher Cahill. This is episode 8. I'll say a few words, and then Accredited Investor Markets Managing Editor Alicia Purdy will interview Alon Goren. So crowdfunding your education. Now there are platforms these days to do that. GoFundMe, all one word, Give College, all one word of course, Pave, and Upstart. I like that last one the best because of duck soup. You never call a firefly an upstart. These are referred to in an article entitled The Kid Who Crowdfunded His College Education in 1987. This was posted on September 6th on NPR's website. Some may recall an enterprising Tom Cruise in the film Risky Business, which, by the way, was 1983. In that film, his character nearly paid for his University of Illinois education through his entrepreneurship. I say nearly because he didn't go to U of I. He ended up going to Princeton. By the way, I can say U of I. Your host has 3 degrees from the U of I. In 1987, according to the article on NPR, Michael Hayes was staring down a 4-year U of I tuition and room and board cost of approximately $28,000. And he stared, but it blinked because Mr. Hayes got a popular journalist to make an appeal. That appeal yielded 2.9 million pennies mailed in to the journalist, and that covered Mr. Hayes' college education. I note that the University of Illinois website, which I checked out just the other day, estimates that 4 years of tuition and room and board would cost somewhere between $30,000 and $35,000 per year, which works out to over 1,000% increase over 28 years, which is 5 times faster than the increase in the rate of food costs. Anywho, I'd also like to alert you to an AccreditedInvestorMarkets.com article by Andrew Rosenbaum. Why? Because it's fun. It's entitled, Elegant Investing. Sip your way to riches. So do you know wine? Do you like wine? Well, why not seek the thrill of the investment chase in a race that suits your taste, literally and figuratively? That's really the point of the article. Well, let's move on then to the September 21 edition of Vogue magazine. We here at Accredited Investor Markets Radio are very au courant. In fact, we're très au courant. Well, in that magazine, Dylan Twinney wrote an article entitled, Welcome to the Strange Upside-Down World of Yahoo After the Alibaba IPO. We don't normally focus on public companies on our program, but this was noteworthy because as a result of the IPO, Yahoo sold a quarter of its holdings in Alibaba and came out with $7 billion. Analysts have looked at Yahoo now, and what they say, or a few of them say, is, well, what's the value in Yahoo? It's got money, $7 billion, plus what it had before in cash. It has a nice website and some advertising revenue, but that's it. Which raises the question of what Yahoo's going to do next. What kind of business is it going to drive itself into or be driven into? That should do for now. Let's get to the interview.
This is Alicia Purdy, Managing Editor of AccreditedInvestorMarkets.com and your host for this week's broadcast. I'm speaking today with Alon Goren. Alon Goren is the CEO and co-founder of Invested In, a technology company that specializes in white label crowdfunding platforms for reward, donation, pre-sales, equity crowdfunding, and lending applications, and of Invest, an invite-only investment platform for sophisticated accredited investors to invest in institutional quality deals. Alon has been featured in the Washington Post, Forbes, Mashable, and The Street. Alon, thank you for joining us.
Thank you for having me.
Tell our audience a little bit about yourself, if you would.
Sure. I am a techie. I grew up as a computer nerd. I, as early as junior high, was working on my own products and things online. I grew up in a house that was run by a family-owned business. So, from a very, very young age, I was working and selling and understanding, the business world. As going through the different various tech companies and having that background, I started to realize that raising money online was really, really tough. And I was dealing with all sorts of social tools to help people do all sorts of fun stuff online, like, play games together and communicate better online. But nobody was using these suites of tools to actually help people raise money online. So we started to do it ourselves, and 6-7 years later, here we are. It's actually coming online now, and it's getting really, really interesting.
There are a number of things I'm sure we could talk about that invested.in does, and listeners can learn more by visiting invested.in. But today's discussion specifically has to do with impact investing, and we're going to talk about the question a little later in the broadcast: could impact investing replace traditional aid to the emerging world? I want to start, Alon, by asking you, what is impact investing, and why should an accredited investor sit up and pay attention? What's in it for them, if you could expound?
Sure. I mean, impact investing just generally is investing in good causes and in companies that do good, in deals that represent, good, basically. I mean, it's really, really simplified when I say it that way. But the general idea is that if you invest in good, good will come out of it. And what people didn't realize in the past, and it took a long time for people to kind of get over the hump, is that being good and doing good and investing in things like clean energy and environmental things and in companies like Whole Foods who take care of their employees and who do good themselves is actually good business, makes you more money, and in the end will prove to get higher returns for investors.
Okay, so impact investing could be something as good for the world as helping someone provide clean water, for example,
Sure.
or investing in a company you love that does good by proxy for the environment or treats their employees well. I mean, it can go as far as corporate all the way down to people that we might never see or experience in other facets of life, other than to say that we've helped supply something that betters them.
Absolutely, yeah. I mean, I think I read the first time I sort of began to understand that was one of my first years in college. A teacher of mine had us read a book called Eco-Economy. This huge, giant, fat book. It was extremely boring, and it basically spent hundreds of pages telling you the exact same thing over and over and over again, which basically said being good for the environment is actually good for business. And the companies that are adopting all these sort of strategies for being good for the environment are actually making more money. And it wasn't hip and cool 15 years ago to do stuff like that. It became hip and cool now. And I think that one of the main drivers of it becoming mainstream is because it actually is good for business. And all these companies that decided they were going to, not waste as much paper, and companies that were trying to create packaging that was more friendly, or companies that were trying to squeeze more out of a barrel of gas, actually were making more money. And over time, it became the mainstream.
So for an investor who, whether or not they intend to be philanthropic, they certainly can be through impact investing. They can really do something that produces a genuine return on an investment and also does something that really provides a genuine aid to someone who really is in need.
Yes.
And can that be local? Is it only international? Is it national? How far down does it go?
I think it's at all stages. So obviously, people want to help their own communities, and starting locally is great. You'll start to learn if you research it and start looking for these types of deals or funds that invest in these type of deals. You'll realize that there's lots of local stuff, and there's stuff all over the place. Local to you is global for others, so it really depends on your perspective.
Now, outside of investing specifically local, where there's a real estate site you can visit, or there's a person that you can see or help, or check in on how things are doing, when an investor moves into impact investing through a platform, how can they safely know their money is actually being used for the purpose they intend, especially something that's non-local, rather than for, something untoward. We had done some research and noticed the Justice Department had highlighted a couple services that were actually funneling money into, a terrorist organization or criminal or just something plain old scammy. How can an investor know that they want to make an impact, but that they actually are making an impact with their investments?
Sure. So the first thing to think about with this is we're talking about not just donating money. You're talking about like an investment opportunity. So you have to look at it like an investment opportunity. If it doesn't make sense and it's too good to be true, then it probably is. And so you have to do due diligence on this just like you would on any investment opportunity. So just like you would go and talk to the founders of a company you would want to invest in, you'd want to do the same with one of these types of deals. That might be a little trickier if it's on the other side of the world, but you have to make sure who you're going through and the people you're working with are people you trust. And a lot of times, because of certain rules and laws too, you're investing in a company or a fund in the United States that then might be doing work outside the United States. So you have to make sure, to the best of your ability, you're treating it like an investment opportunity here. So there's not a ton the individual can do, but collectively with a group of people, with a fund that's hope to see the same type of documentation you would see in investing in something in the United States. And, with the nonprofits, and the bigger the organization, the harder it is to make sure things are above board, but you just have to do your best. And there are third parties that will verify a lot of information too. So investing through something like that is a great idea as well.
Now, given what Invested In does, I'm sure you're exposed to a plethora of investment opportunities and people who are wanting to get a site up and running for their business or their opportunity. Mm-hmm. What are some of the ways that you see that are socially conscious? What ideas are you seeing? And you don't have to get as specific as you feel you can be, without disclosing something you shouldn't, of course. Just to give our audience some idea of what are some opportunities that are out there that you've seen, either successful, unsuccessful, popular, etc.?
Sure. So on the technology side of our business, a lot of the stuff we power is charitable, not all of it, but some. And so we've seen things like the Eva Longoria Foundation raise money for inner city schools in Los Angeles that are predominantly Spanish speaking. We've seen the Avril Lavigne Foundation raise money for Children's Hospital in Los Angeles. And all sorts of others do charitable type of fundraising like that online. But there's also folks that are doing the type of impact investing that we're talking about, which actually gets you a return on investment. And that type of stuff varies as well. So there's a group that I'm actually an advisor to called the California Stock Exchange that is actually building eventually it will be a stock exchange, but it's basically a fund that invests only in deals that have certain companies that treat their employees well, in companies who are doing research into medical opportunities that might not be the mainstream. Essentially, every single investment that group makes will be into something that's socially conscious and considered an impact investment. There's funds that are raising money to invest in clean water projects in third world countries and infrastructure type of investments in third world countries that sound like they're purely social good type of opportunities and sound like charity when you take a step back, but it's actually big business. And guess what? You can do big business while at the same time helping people. And that's exciting.
So how does an investor receive or realize a return on an investment like that? Is it lower than something if they were to invest in a different type of investment? Is it generally lower? Is it generally higher? Is it comparable?
It really depends, but in general it's comparable. The riskier the investment, the higher potential for return, but also the higher potential for loss. And depending on the type of deal, some of these are just a category for deals. You might like to invest in tech startups that are for mobile apps, right? That's a category for deals, and general, though it'll run the gamut on risk and reward. And the same thing happens with social impact. There'll be riskier deals, there'll be less risky deals, but in the end, this is your category and you can feel good about it. And so sometimes you can expect less because you're doing it for altruistic purposes, but in general, there's great opportunities in this space, and you don't have to consider it a loss or a wash or anything like that. You can consider it an opportunity.
Sure. Yeah, that's completely understandable. So you would want to care about the project at the very least. At the end of the day, you would want to care about it so that if it did fail, it's not a total loss in every regard.
Sure, and at the end of the day, when you invest in anything, when you're talking about this deal sense, like on a deal level, if you don't have the time to get in and fully understand something, you probably shouldn't be investing in individual deals unless you're investing in tons of them and you're just following friends and family or somebody you trust. If you're only going to invest one time in something, I would recommend investing in a fund, because then you're fully diversified on day one. So, part of our strategy for that Invest platform that you mentioned during my intro, it's an invite-only sort of marketplace for funds, and the URL for it is inv.st. And if you go there, you'll notice that there's only funds on the site, because we realize that most of the folks who are coming to this platform and who are interested don't have the time to do their due diligence on a deal-by-deal basis. You might not have the time to get to know every single deal that's available in LA in the tech scene, right? Or every impact investment opportunity online. And so what you can do is you can find a manager that you really, really trust, that has a great track record, that has made investments in the past, and that has access to really great investment opportunities, and bet on them. And then on day one, your investment is fully diversified, because you're not investing in one deal that may go south or may go north. You're investing in the next year's worth of deals on a $200 million fund. So it's a great way of doing it, because I know I strayed from the original question, but the idea is that if you're going to care about something on an individual level, you'll probably care whether it's an impact investment or not. If you're going to invest in invested in 3 years ago when we were raising a round from angels in Southern California, you'd want to get to know us and be our friend and look at the team and go, okay, these guys are worth investing in, just like you would want to do on an impact type of deal. And so, it's probably smart to do that no matter which direction you're going, impact or not.
Well, that actually is a segue into my next question. I was going to ask once again about due diligence, and you mentioned that the investing in a fund does give you a little bit of that protection. And I was going to ask if and how invested in, do they do any due diligence? Ultimately, we know that an investor is absolutely responsible to do their own due diligence and to make sure things are covered and that they're comfortable with their investment. However, is there a measure that's provided on your end? And certainly investing in a fund would provide that even further. But is there something that they do? Or are you simply a platform?
So we provide a platform on Invest, but the idea behind it, and most of our customers on the technology side too, have to do at least some minimum basic requirements. And because an investment opportunity doesn't have a prior relationship with an investor when investing online, the idea is that you have to use a broker-dealer to power the transaction. Some of these broker-dealers will take on more of the liability than others. But for example, on the Invest platform, we made sure that we brought on a broker-dealer and a financial partner who do due diligence on every single deal that comes into the site. Not only that, they actually verify before an investor makes an investment that investor can legally make that investment as well. So they're taking on that liability, and they're verifying that at least these are real people with real track records, and they go above and beyond the legal requirements. And every person who invests, especially online, should make sure they have somebody that's doing that. And there's even third parties that can get involved with doing due diligence. I haven't seen many that really go beyond what a really good broker-dealer can do, but you should always ask and make sure that that stuff has been done. Because when you're dealing offline, a lot of times it's the network of people you've dealt with in the past. A lot of times the first investor, the lead, will do the due diligence and everybody else will follow on. But you want to double check and verify everything you're being told, at least at a high level, to make sure everything is above board.
Now, let's just say I'm a new accredited investor and I don't know very much about getting involved in investing. I know that, stocks and bonds are not for me. And I come over to invest and I want to take a look around. What would I need to do? And I want to invest in something that's important to me, and it can really be anything. What would I need to do to start looking for opportunities that might be of interest, assuming that I do not want to invest in a fund specifically?
So if you don't want to invest in a fund specifically, there's tons of sites online where you can invest in opportunities. There's Crowdfunder, there's AngelList, there's things like that. On our consumer quote-unquote site, Invest, we only allow funds because we want those fully diversified type of deals from day one. The idea is that, like I said before, you'll probably have a great chance at a great return, but you won't have that chance of losing it all. And when you do invest in a company, most startups fail. And so you have to think about that when you're making an investment. So this isn't like investing in your retirement plan or in a mutual fund or in anything like that where it might go up 10%, it might go down 10%. It might go up 30%, it might go down 30%. When you're investing in a startup on a site like Crowdfunder or AngelList, the exciting part is that it could turn into the next Facebook, and you might invest $5,000 and it might turn into, $500,000. But there's more likely a chance that that'll turn to zero. And so you have to remember that when you go in. On Invest, you might not get the opportunity to only invest $5,000. We have minimum investments of $25,000, $50,000 on those deals, and even higher on some other ones, but you'll be more diversified. So it's a risk tolerance that you have to look for as well. And when you are looking for individual type of deals you'd like to invest in, you have to treat them, like I said before, you've got to drill down, you have to understand them, and you have to be into it. You have to like what they're doing and like the team that's doing it. And you have to believe in them, because if you believe in them to turn a profit, if you believe in them to get done what they want to do, then it's a win-win for what you're trying to do. Because if they can't get that clean water plant up and running and they can't provide clean water to that area, then you're not only losing your money, you're losing the exciting part of what you're doing, which is making an investment in the infrastructure for that country or for that province or wherever.
Well, I appreciate you drawing that distinction, and that was an excellent answer. I wanted to point out that this is not a commonly thought of crowdfunding type of opportunity that you're doing. And like you said, the investment thresholds are higher. The opportunities are different. So it is not you want to, put money toward the latest film that's coming out, or you wanted even to provide water, but through, by only sending in $50. This is specifically for accredited investors who have met an income threshold, and the opportunities, like you said, may be riskier, may not be, but provide a realistic return when they do succeed.
Absolutely, yeah. The best way to look at, the Kickstarter, Indiegogo type of crowdfunding versus this stuff is Indiegogo and Kickstarter especially, is e-commerce. You're paying money and you're getting something in return. You're getting a product, a service, a special offer, something in return, right? With this, you're making a real investment. You're not investing in a film when you go on Kickstarter, because you're not getting a return and you're not getting anything out of it other than the copy of the film, maybe some kind of producer credit, but you're not getting any of the back end or making an investment at all. It's not legal and they don't do it. And so when you're thinking about crowdfunding on certain sites, you're talking about making an investment in something. You might not get a motorized remote control skateboard that the company is making, but you're investing in the company that makes them, right? So it's a much different type of opportunity, because there's some of the exciting things that the company gets on both sides of it. You get evangelists for the company and early adopters and special people like that. But at the end of the day, when you're crowdfunding something, you're investing. When you're investment crowdfunding, you're making. We don't even call what we're doing on the Invest site. On the imv.st site, we're not even calling that crowdfunding. It's just taking the offline fund world and we're bringing it online, because we're not changing the minimum requirements or anything like that. It's not a inherently social type of gamified system like you would on a Kickstarter and Indiegogo. But very much what is happening on AngelList and Crowdfunder and sites like that are crowdfunding, right? You're going, I'll make $1,000 or a $5,000 investment into this. I'm going to have my face on the deal page. I'm going to share it on Facebook, and I'm going to tell the world about these deals. They're no longer private. And it's a really interesting opportunity, but you've got to beware, because now you're getting access to more of these opportunities that you wouldn't have had access to before. And a lot of the reason why you didn't have access to them before, for some of them and for a good amount of them, was because the deals weren't that great, and so they weren't being spread around. Now there's other ways to get them spread around, so I think what's going to happen, certain things that may have slipped through the cracks before are going to come through, which means amazing opportunities for investors, but it also means that certain things that would have died before they started will get through and will just die at a later stage, which means you're going to invest in a lot of opportunities that will go out of business sooner than they would have before. So you got to be really careful when investing in individual deals. I personally got into this business because I believe in that. I believe that raising money online is broken and we need to fix it, and it's insane to me that we even need to be accredited investors to invest in deals, and it feels completely un-American that I couldn't go on Facebook and tell all my friends and family and everyone I know that I'm raising money for my company, their help. It just doesn't seem right, and it didn't seem right when I first got into this business. And it's getting better and better, but it's still not there. And so you have to take the good, which is, it's becoming more open, it's becoming more transparent, and it's becoming more social, and it's becoming you're legally allowed to market these deals and share these deals, which is good for everyone involved. With the bad, which is, more deals are going to get funded, more companies will probably go out of business because of it. But at the end of the day, more innovation will occur, and it should make the world a better place.
Well, does bringing the investment opportunities online like you're doing, does it change the investment horizon at all? For example, a private equity investment, it would have, an extremely long horizon would be 10 years, but typically 5 to 7, maybe in some special cases 3 to 5. Does that change it at all? Does it shorten it, lengthen it, comparable?
I think it depends on the stage, but in general, I think probably from a very high level, if you just look at everything in general, it will probably shorten it for the bad deals and probably lengthen it or keep it the same for the good deals.
Okay.
The best thing about being able to work on the internet, right, as the techie, I'll take it back to just the basic fundamentals. The idea behind launching a website, being able to be agile in the way you do it, is the fact that you can start a website, you can modify it, and you can end it very, very quickly and easily. So you can fail fast. That sounds bad, to fail fast, but it's actually the best thing and what's made the internet what it is today. I can launch a website tomorrow if I have an idea today, and I can continue to iterate it and iterate and iterate and iterate and iterate and make it better and better and better. And I could put up a new feature the day after tomorrow, find out it was not worth doing, and cut it out and move on to the next thing. Now, if you take that same approach to investing, it sounds terrible because you're putting money in and the company can end in a week. But if you believe in a team and the company might change focus or pivot or do the next thing the next day, you might actually get more opportunities out of that investment, or get to know more people, because any angel investor will tell you that it's not as much the product, it's the team. And when a lot of investors invested in our company, for example, they made it very clear that this might be our first go at it as a company, as entrepreneurs at our own company. But if this doesn't work out, they want to be the first people we call for the next one. And if that doesn't work out, they want to be the first people we call for the one after that. Because part of what they do is they invest in people at the earliest stage of their development, because they want access to them over time. Because they know that if it doesn't work out for us this time, it probably will the next time. Or this time, they're investing in those lessons that we're going to learn, and they want to benefit from those the next time. So it sounds like that sort of fail-fast mentality could be very risky on the investment side, but it's an opportunity. And what will happen is, like I said, there'll be companies that now, instead of their first round going out and raising $1 million, they'll raise a couple $100,000 on a site like AngelList or Crowdfunder, and they might get some money in the door before they ever would have before, which could be good or bad, but will mostly be good because they'll be able to learn and understand if it's worth getting into from the beginning. And if it's not worth getting into, they can move on to the next one.
Okay, well, I'm going to get a little off topic for a second. Sure. You have a past in rock and roll. And I just was wondering if you could explain to our audience briefly. And it's come up before in things I've read about you. And so I wanted to just share with our audience, what has it given or taught you that you can apply to what you're doing now, or has inspired you to bring you to where you are now, and what this latest endeavor with Invested and Invest?
Sure. I mean, there's a lot of lessons that could be taken from one to the other. At the end of the day, I think that being fully invested in one thing and running it right means that you're, I don't know the right way to put it. Basically, doing something right translates very well. So I could look at throwing together a concert that had 20 bands playing at it and 5,000 people attending, and translate that into a tech event on impact investing and bringing those people through the door. At the end of the day, you go through a lot of the same motions, but there's just certain different messages along the way. And actually, talking about impact investing kind of fits in a lot to what we did back then, because we were punk rockers singing about equality and singing about environmental things, singing about change, right? And that's what it ends up being about. And what you learn is you can take lessons you learned in previous lives and implement them in the next one. And I truly believe that all of the things I learned in being in a band and throwing concerts and bringing people in the door actually translate very, very well to doing business. And at the end of the day, we learned a few things, because I was in a band and I was actually working at MySpace at one point, and you kind of start to learn the correlation between different things. And sort of the biggest lesson I learned is that I was in a band that played music that most people wouldn't be interested in. Like, very, very honestly, right? I would have been insane to think that I would have gone to the mainstream and that our band would be on the radio and people would listen to it, because for the most part we were making noise and we were screaming and we were causing trouble, and we didn't look like you wanted to hang out with us, and we didn't act like you wanted to hang out with us. But what we realized is that in the town we lived in, there were only 10 kids like us, and in the town over, there's another 10 kids. And on the other side of the United States, there's a town with 10 more kids. And when we came online and started sharing things online and being sort of the first generation to do stuff like that online, you realize that having a very, very niche market to what you're doing wasn't actually that small when you expanded it and extrapolated it across the world. When we started to expand and get online and do things like that, some small punk band that struggled to get 50 people to watch them in a bar in town had 20,000 fans online and people all over the world paying for their T-shirts and their CDs and digital downloads and things like that. And you realize that we would get paid to fly places and play shows, but we couldn't book a bar in our town. And if you think about that, when you go online, it creates huge opportunities, not just for musicians, because it goes across all industries. Products. You see the things that happen on Crowdfunder or on Kickstarter. People struggle to sell their products. People struggle to get investments. And then they get the right distribution. They come online and the right people find out about them. And somebody making those, remote control motorized skateboards that sound insane are selling thousands and thousands of products. And they're running a business. And the same thing happens with investment opportunities in the impact space or anywhere else. A startup that's doing something that might sound very, very niche could get out to the people that really understand that. And you could create a CRM tool for the guys that do the accounting at large firms and try and find the people around you that are interested in a product like that. And you might not find very many. But then you can take it online and find that there are potential users for a product like that. Not just that potential users for a product like that are also investing in a product like that because they understand the potential bigger than the average angel investor you're going to Tech Coast Angels meeting. And then things can spread. And that's sort of the biggest lesson I learned in all of that, was that, it doesn't exactly matter how big a market might be when you're thinking about something. It might sound like it's a small opportunity to the average doctor or lawyer that hangs out in an angel meeting, but they're not your customer. If you go online, if something works for you and something makes sense for you and it's something that you're proud of and you would use as a product, there's a very, very good chance you'll go online and find millions of people just like you all over the world that are interested in that as well. And guess what? Thanks to the internet, the world is small now. You can find those people. There's a few things that anybody can do in a day to find out how big a market is for a potential opportunity online now. It's an amazing world, and you can bring that across to investment opportunities. So you can find investment opportunities you're really, really interested in investing in, no matter what the market is. And it's great for the people looking for investors too. It might be really, really hard for somebody doing a specific kind of startup to raise money in their town from the investors in that town because they might not understand what they're going through. But if they go online, if they utilize one of these services, they can get access to these investors. And that's what's exciting about now.
Well, using your rock and roll life eye-opening sort of analogy where, you couldn't book a gig in town, but yet you could fly all over the country and have fans, I'm going to bring it full circle and ask you our main question. Could impact investing replace traditional aid to the emerging world? And based on the observation, it sounds like the answer is yes. However, could you expound for our audience on how impact investing sounds like something that would be of, or dare I say, should be of interest to a majority of investors in the world? I mean, it seems just like a win, if not a win-win in any regard. But if you could give some examples, maybe some things that you've seen or how change has been sparked by impact investing, by people who have the money to really make a difference and are funneling it not only for returns, but that it really is doing something significant to improve the emerging world. And what is the emerging world?
Sure. I mean, there's different, there's different opinions on what the emerging world is depending on who you talk to. There's plenty of countries that aren't third world countries that, compared to where we live, in the United States, you would consider it to be emerging. And there's obvious the places that don't have clean drinking water that need help, and we should try and help. But when you're talking about the impact opportunities and everything we're talking about today, I think at the end of the day, there's a sort of accountability that you not just expect, but that's required when making an investment. That isn't exactly there in the nonprofit world. People try to keep them accountable. People try to, there's a certain amount of money that everybody gives to charity, whether it's because they really want to help the charities, or some people are just avoiding paying a certain amount of taxes, right? They go, okay, do I give it to the government or do I give it to a charity, right? And that's one type of charitable philanthropic donation, right? And then there's the Bill Gateses of the world and the Bonos of the world who give millions and millions and millions of dollars to charity and all events that help charities, right? But when you're investing, you hold people accountable because it's an investment. And what I think has happened with a lot of charities is it's gone the way of the way sort of the government works and the way that corporations work, except for it's even a little less accountable than the corporations. If you've ever done business with nonprofit organizations, they're extremely, extremely, extremely slow to work with. A lot of the people that are working there not because of the high pay that they're getting, because most nonprofits, aside from a few of the really huge ones, don't pay as well as the for-profit world, right? So they're doing it because they love it. But they're not necessarily doing it because they're the best person for the job there, which means that things happen slower, things aren't as accountable, and it's not as cut and dry as business, right? In business, you might invest $100,000 in a company and look at that company and see that the company is moving up because of various reasons, because whatever the KPIs are for that specific company, right? Some companies are fighting for users, some are fighting for revenue, some are fighting for profit, and some are fighting for all of those things, right? So you can go and look at your $100,000 investment and say, this not only created 1 million bottles of water for this place, but there's actually this much profit that was made, or it stayed sustainable as a business, right? And we're still in business and we're growing. With a nonprofit, you could give $100,000 and the only metric you might see is how many bottles of water came out of it. That's a good thing too. But at the end of the day, because it's an investment opportunity, they're held to different standards and they're forced to do certain things. And, you know, I wish the nonprofit world worked more like the for-profit world, but that's something that would probably take many, 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 many years to change, if ever, because the incentives are just not there for folks. And so, you know, the sort of financial motivations and those types of incentives, obviously you're contributing to that nonprofit because you believe in it and you hope for it to do what they claim to do and want to do, but it's really tough. And so I think that from a very high level is where it's at. You know, a lot of people really believe in that impact space because of that accountability. And because, you know, if you're doing it for a business, you're going to grow that business. Imagine if Jeff Bezos started Amazon as sort of an organization that did good and was, you know, not just a bookstore, right? It would be very, very amazing to see what would happen if more guys like Bill Gates decided to run philanthropic organizations. But they're fully incentivized to go into the for-profit world. So this is a way of getting the best of both worlds, right? Having people go for profit, but also for good. I'm not sure if that exactly answered your question, but...
Well, I think saying yes or no is just not the easy answer, is what it sounds like. It really isn't, because it probably could in theory, but will it would be a different question, it sounds like, is what you're saying.
Exactly. And, you know, it's one of those worlds where you donate to a cause and then you find out how much the CEO was paid. And then you look at that and you go, well, that doesn't sound right because I donated to that cause, not to the CEO's paycheck. But you have to take a step back and understand that, well, if that CEO wasn't the CEO, would they be as effective? Would they raise as much funds? Would they do as much good? And then you have to go, well, maybe, maybe not. And then you go, well, that CEO to make that much money, it's hard. It's one of those things that it's impossible to really understand or answer because it seems wrong. But at the same time, you have to pull that person away from taking a CEO gig at a for-profit company that'll pay them double or triple or quadruple what they make at the nonprofit. So it's a really tough sort of comparison to look at, because you want people to do all this stuff for just the good of doing that stuff, but most of us didn't become accredited investors for just doing something for the good of doing something. We got paid, and that's why we have money in the bank. So,
but you would think that it would. Does it have sort of every little bit? It can't hurt. It absolutely can help. Whether or not it's going to be life-altering on the grand scale of the world, it might just alter one person's life or several people's lives or the lives of a small town or something like that, making it worth it.
Oh, absolutely. And I don't want to discount giving to charities, and I don't want to discount impact investing or anything like that. I think that the more the merrier, and it's good. I think there's going to be examples of sort of quote-unquote corruption on probably both sides of it, with people not doing the right thing. But in general, we should be very happy people are doing both things.
Yeah, I think that's actually a great way to put it. And the accredited investor who wants to do both can do both. And that's kind of the whole gist, is that there is an opportunity, not just to, if you're someone who really just feels maybe some guilt or something about simply investing for monetary gain, there certainly is an opportunity out there to do some genuine good on whatever level by impact investing. But that at the same time, you have to know what you're investing in, I suppose.
Mm-hmm. Yeah. Yeah, you've got to know, and you can know, and that's one of the greatest things about what's happening online. There's the greatest amount of transparency ever in opportunities, and you can use it to your advantage.
That's a great place to bring it full circle. I appreciate you taking the time to talk with me today, Alon. Why don't you go ahead and give your websites so that our listeners can go ahead and look? I mean, they're probably very interested at this point. We've had a great discussion on can it help, does it help, what does it entail, and what it is and what it isn't. So go ahead and let people know where they can go to learn more about both your platforms.
Thanks. If you just actually go to investedin.com, you can access our whole portfolio. So if companies that we've launched, like the Invest platform and invested in white label services, and also examples of our clients and also some of the things we've invested in. So just check out investedin.com.
Excellent. That's all the time we have for this episode of Accredited Investor Markets Radio. If you liked what you heard, please take a minute and write a favorable review on whatever platform you've tuned into. With investor education as our first priority, this is your host, Alicia Purdy, on Accredited Investor Markets Radio.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.